Yeah. Let's bring in our headliner of the day, Brian Belski. He's the chief investment strategist at BMO. He joins us live today from Minneapolis. Good to see you again. Welcome back.
Thanks for having us, Judge.
I'm a play off the Tom Lee thing today. He says the market's focusing half empty. Are you a half empty or a half full guy today?
Half full, brother. It's always better to be positive. You need to have faith, and in what's faith in our market.
Got to be a realist, though. Got to be a realist. Can't be a Pollyanna. Got to be a realist.
So here's my Pollyanna, non-Pollyanna. Well, the market is transitioning into more of an earnings-driven market. There's no doubt about that, Scott. And in earnings-driven markets, the return structure becomes much more volatile, quite frankly, and actually still remains positive, but obviously not as positive than in a momentum market. That's number one. Number two is we've had a heck of a run in markets, and I don't know about you, but I'm having a hard time getting hold of clients. I've had more out-of-office responses to the last two reports that I put out, so I think a lot of people are on vacation from a personal basis. I think that's exceedingly positive, but I think we're kind of getting back into this August, September doldrums. Number three, next week we have Jackson Hole, and if you remember last year, Mr. Powell changed the mandate on the Fed. And moved away from inflation to employment. We moved our market targets up last year at that time because we knew that the gas was going to be on the Fed for a while. And I think next week could be interesting. But at the same time, I think the Fed's going to be playing defense with respect to the taper. And so that's why we put out our piece last night in terms of too much taper vapor in the markets. And I think markets want the tantrum because, quite frankly, the majority of institutional clients are underperforming this year. They want to be able to buy the dip. They missed the move. And we actually think that there's a very good chance that the market could actually rally when we know what the taper is going to be. Oh, by the way, just like it did last time, the market, when Bernanke talked about taper, hinted about tapering in Congress in May, market was down 5.8%. Right after that, the market rallied 10%. By the time the Fed began to taper and then actually began to QE, 11 months later, stock market was up 10%. Drop the mic. We're being way too short-sighted on this. We need to focus on double-digit earnings growth, still very low interest rates from a longer-term perspective, and stop trying to time the market and call for all these near-term corrections.
Well, but do you think we are on the cusp of a correction because we're going to get the taper? I mean, you painted a scenario in which we could get a pullback of some unsettling feeling. But, of course, you think it's a buying opportunity. But before we get to buy, are we going to be worried about a sizable correction first?
Not a sizable correction. I'll go on record, not a sizable correction. Anybody that can call a sizable correction, God bless you. A sizable correction was our cyclical bear market we saw last year, which was once in a lifetime. We've had corrections of 10 to 15% through all bull markets. Remember, we think we're in a 20 to 25-year bull market, Scott. A 6% correction is not going to tell me to be bearish, quite frankly. And I think people cannot be fast enough. Jack be nimble, Jack be quick. I've been on your network for over 20 years talking about try to time the market. Be an investor, and it's proven correctly. So you have to stick with your process and discipline. Clearly, we would be adding to portfolios on pullbacks, but we're going to stay fully invested because that's how we make money and that's how we run money longer term.